Welcome to the Be Smart podcast. I'm Cameron, the managing editor at JaredDillianMoney.com. And everyone knows Jared here, our very own podfather. How you doing today, Jared?
What is up?
We got a special episode today, a lot to cover.
Yeah, let's do it.
I want to first start by talking about some familiar brand names: Payless Shoes, Toys R Us, Claire's, and Red Lobster. Jared, did you ever frequent any of these stores in their heyday?
Believe it or not, I got my ears pierced at Claire's like two and a half years ago. I was at a mall in Nashville. It was a very nice mall, and went to Claire's, had a great experience, got my ears pierced. The long story is I had my ears pierced when I was in high school and college, and they eventually grew in, so I was having them re-pierced. Red Lobster I've been to a couple of times. I don't have any kids, so I never went to Toys R Us. Payless was the other one.
Yeah.
I spend more money on shoes than that.
Those cheddar biscuits, though, at Red Lobster, man, those things slap. You know, I remember getting the original Star Wars trilogy on DVD from Toys R Us back in the day. I mean, this was back when DVDs were new and all the rage. So it was really kind of a bummer to see Toys R Us bite the dust. Man, I think I even got like one of those plastic lightsabers back in the day from there. Such fond memories.
The weird thing about Toys R Us was, like, usually when a company goes bankrupt, there is plenty of warning. Like, the bonds are trading at par, then they're trading at 95, then they're trading at 90, then they're trading at 80, then they're trading at 60, then they go bankrupt. Toys R Us bonds were trading at par, they're trading at par, they're trading at par, they're trading at zero. They just filed, and like nobody had any warning whatsoever. That's what was unusual about the Toys R Us bankruptcy.
Like a lot of these neighborhood staples, Toys R Us was driven into bankruptcy by private equity. Now, the problem with private equity isn't that acquired companies are about 10 times as likely to go bankrupt. It's more so that the business model of private equity relies on using ungodly amounts of leverage to assemble and buy portfolios of private companies, which has become a major problem. I want to talk about this today, but first I want to thank everyone who participated in our recent survey. We ended up polling over 5,000 of our readers, which is amazing. And the overwhelming majority of you said that if there's any chance that The Big Short would happen all over again, you'd want to know about it. By the way, Jared, there was one question in there. What are your investing goals for the next 12 months? And one of the better responses was, I want to rub my friend's nose in the cinders of the destruction of the Magnificent Seven. I mean, as good a goal as any, right? Today, we're going to cover everything you need to do to prepare for the next Big Short as it pertains to the hidden dangers and risks in the world of private equity. Jared, first things first, though, let's catch everyone up to speed. For those who might be unaware, what is the best way to explain what private equity is? And when did you first notice it was in bubble territory and demanded your attention? Does the situation today remind you of 2006 when the average person had no idea what a negative amortization mortgage was?
You have public companies and you have private companies. Public companies are listed on an exchange. Their shares can be traded by the public. Private companies are not listed on an exchange. I would say that there's many more private companies than public companies. And there's a whole debate about whether it makes more sense to go public nowadays than to stay private. There's big advantages to going private. But basically what private equity firms do is the goal is to assemble a portfolio of private companies, okay? And then apply management techniques over time to make them more efficient, and then sell them at a higher multiple of earnings in a span of, I would say, 3 to 10 years, right? And when they buy these companies, they go into debt, right? So private equity made a lot of sense in 2017 because interest rates were zero and you could just, you can borrow like an infinite amount of money at a very low interest rate to buy these private companies at a very low multiple. You could buy them at 4 or 5 times earnings. Now it doesn't make as much sense because multiples are much higher. They're trading at 10 or 12 times earnings. And obviously interest rates are 5%. So the carry costs are much higher. But there's basically debt on top of debt on top of debt. It's an insane amount of leverage. And what's funny is, if you look at the stocks of these private equity firms, whether it's Blackstone or KKR or Apollo or whatever, like, this is supposed to be a slow, boring business. Like you're just buying private companies and sitting on them. But the stocks are actually very volatile. And the reason they're volatile is because of the leverage inherent in the model.
From what I've read, private equity already has a somewhat poor reputation. In the last decade, it's killed 1.3 million retail jobs. And in 5 of those years, private equity bankruptcies in healthcare exploded 112%. On top of that, some other key headlines here. Number 1, private equity ownership of housing is associated with rising rents and higher rates of eviction. Number 2, private equity buyouts of private colleges lead to higher tuition, higher student debt, lower graduation rates, and lower earnings. And number 3, when private equity takes over a nursing home, mortality rates jump by 10%, which implies that compared to non-PE owned nursing homes, private equity ownership causes more than 1,000 additional deaths every year. Jared, despite all this bad press, why hasn't anyone shorted private equity before? Is this a PR problem or is it more than that?
It's not a PR problem. I mean, these are actual problems. And I think people are starting to short some of these names. Basically, when you look at private equity, if you're a founder and you own a business, your time horizon is infinite, right? Like you want to stay in business forever. You want to stay in business for 50 years and hand it off to your kids or hand it off to somebody else. Like your time horizon is infinite. So if your time horizon is very long, what you want to do is satisfy customers. You want to keep them coming back, right? But if your time horizon is short, if you're a private equity firm, then you want to extract as much value out of this business as possible in a short amount of time and then sell it. And usually what that means is firing a lot of people, right? And raising prices, okay? So, and basically declining service as well. So if you're a founder and you have a business and you have a bunch of employees, I mean, for sure, you probably have some employees that you could fire that aren't adding a lot of value, but you keep them around for some intangible reasons, right? Whether it's company morale or whatever. Like if you're a private equity manager, none of these concerns have any effect on you at all. And you're just going to remorselessly fire a bunch of people to make the business as efficient as possible and raise prices. And I think private equity, I haven't seen any studies on this, but I think it's been a big contributing factor in inflation, right? Because the first thing private equity does when they take over a business is raise prices. The car wash down in Murrells Inlet that I go to, it was an $8 car wash, and then one day it was a $12 car wash. They raised prices 50%. It's obviously owned by private equity.
Let's go back to 1980, pre-Reagan here. There were only 24 PE funds. Today, there are over 17,000. In 2000, private equity firms collectively managed about $579 billion in assets. Today, the global industry manages almost $8 trillion. 2 of the biggest are KKR and Blackstone. In 2005, KKR had $15 billion in assets under management. Today, it's $575 billion, a 3,733% increase. And another fun fact here, private equity employs about 11.7 million people, which is roughly the population of Ohio. Is it fair to compare this level of growth to the dot-com bubble in the late 90s to early 2000s or the rise of mortgage-backed securities in the mid-2000s?
They're all 3 different scenarios, but when you're talking about 3 different bubbles, like absolutely it is a bubble and the growth rate kind of indicates that it's a bubble. You can't swing a cat without running into a private equity firm at some point, something that's private equity owned. PF Chang's is a good example. That actually was taken over by private equity about 5 years ago. I wrote about that in the Daily Dirt Nap, went there for dinner by myself. Came out to $64 for one person, right? So, they're extracting as much value out of it as possible. And if you ever went to PF Chang's in the late 90s when they first opened up, it was a completely different experience. It was a much nicer experience. So, if your question is, .com, mortgages, private equity, are these 3 bubbles? Like they're absolutely bubbles. And this one is enormous and it's kind of unseen. It's kind of operating under the surface because it's not, these aren't securities. They're not listed on an exchange. And a lot of people have talked about this before. Like, can you have a bubble in something that doesn't have a price? Really, the only prices we have to look at are the stock prices of the private equity firms, which doesn't give us a lot of information. These firms have portfolios of companies. They mark them however they mark them. Some people get outside appraisers. Sometimes they mark them themselves. We don't really know where these marks are. They're probably optimistic. But if this unwinds, it could cause chaos.
And what is it about these companies and their rapid growth? Is it even possible they get to the point where they run out of companies to buy?
We're getting to that point right now. With 17,000 private equity firms, they're all looking for deals. Everything is expensive. They're getting into pizza places and laundromats and mom and pop businesses that don't make any sense. The other thing that's hard about this is that if the private equity industry implodes, it's probably going to affect the smaller players more than the larger players, right? The big ones like KKR and Blackstone have a lot of dry powder. They're going to be able to take advantage of deals on the cheap, but you're going to see thousands of PE firms go out of business within the span of 6 to 12 months.
You've mentioned in the past that Blackstone bought the Tropical Smoothie franchise for $2 billion. Tropical Smoothie has 1,400 stores, and if I'm doing the math right, that means each smoothie shop is worth about $1.4 million. My question for you is, what does that mean industry-wide from a value perspective? $1.4 million for a smoothie shop. I mean, I would imagine private equity would go after something like health tech, or I don't know, like literally anything else besides smoothies. By the way, Tropical Smoothie can kind of kiss my ass. Last time I went there, I got food poisoning from one of their sad little flatbreads. So, they're dead to me. But going back to the question, industry-wide, what does that mean from a value perspective?
1,400 stores. What was the amount that they got bought for?
$2 billion.
$2 billion. So, and you said it was like 1.4 million per store.
That's right. Yep.
Each store is probably doing $150,000 to $200,000 in revenue. It's not really a great business. And my guess is the first thing that Blackstone is going to do is they're going to close like 200 underperforming stores and raise prices and fire a bunch of people. That's what they do all the time. So, I mean, if there's any winner in this, it's the original owners of Tropical Smoothie Cafe, right? Like, good for them for selling out for $2 billion. Like, they're billionaires now. Like, terrific.
That's nuts. Deal volume has slowed. In fact, it's the lowest it's been in decades, 44% below 2022 numbers. In 2023, distributions to investors were the lowest since 2009. Yet it seems like private equity is all the rage. You got celebrities like Kim Kardashian and Jay-Z starting their own PE companies. Why would they do that now? And what does it mean when celebrities are jumping on a trend bandwagon? It didn't exactly work out too well for FTX. And quick follow-up question, what should I look out for if I wanted to spot a sentiment signal?
I think that celebrities are a good sentiment signal. I mean, Kim Kardashian is super successful. I don't deny that. Still, my guess is she's pretty uninformed when it comes to private equity. There was also a football player, I think a quarterback. It was Caleb Williams or something like that.
The Bears quarterback. Yep.
The Bears quarterback. And he's like 23 years old or something like that. And he starts his private equity firm called 888 Midas. Like, we're going to mint gold coins here, like Midas. So, I mean, all of this, and actually you asked me earlier why I got interested in this. Well, it was around Christmas time and Blackstone had done this music video about their firm, which was, have you seen the video? I mean, it's,
yes.
It's the most self-congratulatory thing I've ever seen in my entire life. That's really when things started to get hard. Blackstone's stock is basically unchanged in the last 8 months since that video came out, right? And this is with the stock market up 15 to 20%. A lot of people look at the chart of Blackstone and they're like, I don't get it. Like, it's still on the highs. But what you don't understand is there's been massive underperformance relative to the S&P 500.
Didn't Tony Robbins put out a book too on private equity?
Oh, yeah. Tony Robbins. Yeah. More than the book, he's working with this private equity firm called CAZ, which is getting retail investors to invest in private equity. So the book, I didn't read the book, but I read the Amazon reviews. And a lot of people complained because it was like a big advertorial for his PE firm and like trying to get people to invest.
Let's shift gears because private equity companies have another similarity to the financial crisis, which is the backlog of deal flow. And that's 4 times what it was during the global financial crisis. Why is no one else talking about this? And realistically, what would have to happen for deal volumes to pick up? If all the quote unquote good businesses are already bought, what is left?
There's not much left. If interest rates came down, and they are coming down a bit, that might cause deal volume to pick up. But the bigger issue is the exits, right? Like a private equity firm has a portfolio of companies. They hold on to it for 3 to 5 years and they try to exit. Sometimes they try to IPO. Well, now there's no IPOs. You can't IPO. Well, then you try M&A, and like there's no appetite for acquisition of some of these companies. So they're stuck with them and they're holding on to them forever. And because there's no exits, they're not getting cash. And because there's not getting cash, LPs are not getting distributions. And so you have pension funds and endowments, and they have this private equity allocation that's taking up like 30% of the pie, and it's not producing any cash for them. So it's a big problem.
The biggest concern I have, which you've mentioned, is debt and leverage. The private credit market grew nearly as fast as private equity. Since 2015, the private credit market quadrupled in size, but there are signs of trouble. Private equity's distressed debt is up 18% since March, and some buyout firms are currently facing interest rates as high as 19%. Aren't those kind of like, used car loans and high-risk buyer numbers? Why is their debt so high, and what's the way out for them?
The attraction of private credit is that the interest rates are higher. So if you're an investor in private credit, you can get interest rates, you can get yields of about, 2% of higher than what you would get in the junk bond market. And by the way, the private credit market is now about 1.7 trillion, which is about exactly the size of the junk bond market. Like the private credit, I actually know less about private credit than I do about private equity. But this is probably a bigger source of systemic risk than private equity is, because really that's debt on top of debt on top of debt.
Direct lending funds managed by firms like BlackRock, KKR, and Oaktree Capital Management have seen their credit rating outlooks downgraded to negative. The reason was for non-accrual loans. Aren't non-accrual loans just a fancy way of saying loans where the borrower isn't making interest payments or repaying as scheduled?
That is correct.
And isn't there another type of loan where private equity companies borrow money against their portfolio companies?
Yeah, that is called dividend recapitalization or dividend recap. So basically, you have a portfolio of companies and you need to pay cash to LPs. So you borrow against the portfolio to pay cash to shareholders. So it's leverage on top of leverage. So, the thing that this has in common with the financial crisis, with the housing crisis, is the debt, right? You mentioned the dot-com bubble. The dot-com bubble really was pretty harmless. Like a lot of retail investors got sconed and people lost a lot of money, but we barely got a recession out of that. It really didn't have a lot of systemic effects because there wasn't any debt. When you start introducing debt into the equation, that's when people get into trouble. So, I've said before, I don't think the private equity bubble will cause a recession. But if we do get a recession and this unwinds, it's going to prolong the recession for a very long time. The next recession we get could last 3, 4, or 5 years because of this private equity unwind.
Well, we'll look forward to that. That sounds fun. So sentiment levels are through the roof. Deal volume is slow. And as a result, private equity groups globally are sitting on a record 28,000 unsold companies worth more than $3 trillion that will need to be refinanced because of distressed debt and interest rates in double digits. All the while, private equity companies are borrowing against their own portfolios. I mean, this sounds like a recipe for disaster, no?
Yeah, I mean, if you say you have 28,000 companies and 10,000 of them were bought in 2019, well, in 2019, we had 0% interest rates. And now you have to refinance that in 2024 at a 6% interest rate. Like that makes things very, very hard, right? So that's why really it's the lack of exits that is the real problem, okay? like, because they're forced to sit on these companies forever and keep financing them at higher and higher rates.
Well, we could spend all day talking about the problems here, but let's get down to the solutions, i.e. the actionable step-by-step moves needed to trade something like this. Many of our listeners already know this, but you were in the Coast Guard, and there are these watchtowers overseeing everything happening on the coast, keeping a watchful eye on potential threats. So in the same spirit, we've created a comprehensive white paper aptly titled Operation Watchtower to monitor and detail everything unfolding in the private equity sector. Could you tell us a little bit about what this report is about, how much it will cost our viewers and listeners, and what people can expect with it?
We've kind of run through some of the basics in this podcast. It's about a 35-page document, which goes into detail with a lot of charts that really lays out the bear case for private equity. And it also talks about, okay, if this is going to blow up, how can you protect yourself? And that's what we're going to get to later. It doesn't cost anything. It's totally free.
We have a link below where you can sign up to get a notification when it's ready. So click the link in the description below, and this free report will be sent to your inbox on August 20th at 1 p.m. Eastern. It's definitely a must read, so use it to prepare for our main event or part 3 of our 3-part expose, The Big Short 2.0, and mark your calendar for August 22nd at 1 p.m. Eastern time. That's where we'll put everything we're doing into action and cover everything you need to do and the steps to take. With that, Jared, any last words before we go?
The market has been pretty turbulent lately. We took a big drawdown in the S&P, volatility spike, this whole carry trade unwind. We're kind of back up on the highs. People think that the worst is over. I worry about this a lot. I worry about if you have some kind of market dislocation that triggers a recession, we end up in recession. And look, private valuations should mirror public valuations, right? So if we get into a bear market and public valuations are down 20%, then private valuations should be down 20%. And if private equity firms aren't marking their portfolios lower, there's going to be a lot of questions. There could be demands for redemptions. That's where it starts to unwind.
All right, Jared, thank you for your time. I got to get out of here. I got to go pick up some PF Chang's.
Get the Mongolian beef.
Yeah, that's not going to give me food poisoning, is it?